had the conversation with Mr. Jignanshu Gor, the Director and Senior Research Analyst at Bernstein earlier to understand the thesis behind it. Hear out a slice of that conversation. Jignanshu, just wanted to begin by understanding the rationale for this, because at a time when people are looking at staple, talking about rural recovery, monsoon election and all of that, you've actually gone ahead and initiated coverage on urban discretionary, which as it is was doing well for the last couple of years. What makes you sanguine about, let's say, retail, restaurant over staples?
So Anisha, that's a great point. If I look at how the discretionary spend in India is construed today, the coverage for the discretionary spend across retailers, restaurants, including whether it's digital or offline, is restricted to top 10% of the population. We think that as increasingly affluent people, both in the top of the pyramid and the middle of the pyramid, are looking to express themselves. And one way of expressing themselves is eating out, is buying trendier clothes. And hence, we believe that the discretionary spend is waiting to grow in the bottom of the pyramid or in the middle of the pyramid and outside of metro cities. So I do not think that discretionary is just a metro story. In fact, it is a story where affluences and urban and rural India have people who are affluent in both places. So we think that the recovery for the discretionary from a narrative perspective is going to happen in the next 12 to 18 months, which makes us confident of the prospects of this sector itself. I think the second part of the interest that we have is this debate between digital versus offline. We think while has been an exciting story over the last few years, the path for offline retail expansion in India is nowhere near over. We've just started on that journey of organizing and formalizing the market. And I think there is a long runway ahead for companies who are able to find efficient business models.
And I'm guessing you expect this efficiency to come home for DMart, because you're still positive on the stock, while the street is worried about the kind of competition that we are seeing not only from e-commerce but quick commerce now, and the kind of investments coming in. Talk to me about your thesis on DMart.
I have two big thesis points on DMart. One, I think the target group or target audience that quick commerce has addressed over the last few years for their growth, and which they will continue addressing in the next few years, is fundamentally different from the target group that DMart addresses. DMart plays value and versus convenience play for most quick commerce players. Having said that, DMart is still present in only around 130 cities compared to 500 to 600 cities of any meaning in India. So I think DMart still has significant growth potential. In fact, if you look at their cash flow, their mature stores have started throwing enough cash flows, which allows them to then reinvest that into store additions from a longer term perspective, which that turning point has just happened for them over the last 2 to 3 years. And we expect them to accelerate the store addition. So coupled with this value positioning, which they are unbeatable at, frankly, today, versus the availability of free cash flow from their mature stores in their core states, allows them to continue their expansion. It is one of the most efficient retailers, which then allows them to also open up stores in very small towns, as they have done in their core states. So those 3 points give me the confidence that DMart has potential to grow and not be as affected by quick commerce as most people are expecting them to be.
Yeah, because the headlines coming in from the likes of Zeptos and, the big baskets of the world has you a bit worried as to how the overall retail participation is likely to move. But since we're talking about retail, the big one to talk there is Trent. And it's, kind of a black box in its own sense as to how the stock just keeps on moving to higher valuations. I understand it's right now at 110, 115 times, and you're still coming out with a buy report at that stock price.
Yes. Again, I think I like Trent because it is one of the few apparel players who has shown outperformance and significant outperformance in the industry. There are three reasons to appreciate their performance and expect that it's going to continue in the future. One, their entire portfolio is organic. It has been built on private label and it has been built on their supply chain strength. Two, a large part of their store network has been added only in the last 2 years, which means by design how an apparel or a grocery store's life cycle works. The store maturity is in the future. Those stores are going to mature in F25 and F26, adding to earnings potential and increasing the FCF per store. Third, even while they have grown the network, they have around 550 outlets compared to someone like a Reliance Trends who has more than 2,000 outlets. So even if they keep adding 150 to 200 outlets per year, they will not run out of store addition headroom for a while. I think these 3 points put together give me the conviction that they can continue to execute the way that they have and grow. And hence the outperform call from our side.
Yeah, you're already pegging a value of almost 8,000 on the stock, and it's very close to that. Let's see where it heads from there on. But talk to me about the thesis on restaurants as well, because last couple of years haven't been the strongest for them, whether it was the burger players or the pizza players, both had it a bit more difficult. What's likely to change from here on, and what's the individual stock calls there?
So I think we expect that at a consumer level, the discretionary demands from Q3 onwards should pick up, specifically for restaurants. So while that is an industry view which will be positive for all the four players, we think from a long-term perspective, there are two parameters which differentiate restaurants. One, how efficient is again their business model in extracting EBITDA or ROCE from the revenue that they make. And two, basis the cuisines that they are playing in and the brands that they have, what is the longer term TAM for those individual cuisines and brands. I think on the first one, we think because Jubilant has been able to, it was the only player with a positive SSSG in Q1 of F25. This came at an expense of higher marketing fees, but their backward integration into commissaries is for me a great value driver for Jubilant. It allows them to attract demand while keeping their margins positive, which most other players don't have. We also like the efforts that they're making with Popeyes. We still need to see more proof points from the company on how much they can go ahead on Popeyes. But those two areas, continued Domino's growth and Popeyes, can be the revival for Jubilant. Uh, in general, the other part that we appreciate for restaurant space in India is the necessity to do multiple cuisines. I think we Indians like the variety in our food. As they say, the food tastes along with language changes every 50 kilometers. And hence, the market for any single cuisine, single standardized product is expected to be limited even in the long term. Here we think Devyani, with its focus on cost up, besides KFC and Pizza Hut, along with Wango, which is a South Indian cuisine, has the right ingredients to scale up and show that scale up for longer term. So Devyani and Jubilant become our outperform calls. Sapphire is our market perform call, and Westlife is our underperform call.